The US dollar still remains vulnerable given the growing recession fears around the United States. We have big inflation data and retail sales this week from the dollar. How is it going to react, guys? Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So over the past few weeks, the greenback has been very much tilted to the downside. We've lost that edge that we had from the early part of 2024 as we start to see cooling in inflation, a slowdown generally in terms of some of the key economic data, just showing some fragilities in the US economy, and rate cut bets ramping up from the markets, expecting multiple action from the FOMC in September, November, and December. If you take a look here, firstly, technically, with the dollar index, as you can see, that edge that we lost late in June after all this edge that we had because we had solid data, inflation was still high, we were not pricing in a number of rate cuts, but now things have changed, for the dollar, and we are losing that edge. We've lost that momentum to the upside, for the past 1, 2, 3, 4, 5, going on 6 weeks, we've been very much weighted to the south. The bears are largely in control right now for the greenback. If you have a look technically here, this big zone around this sort of 102.80 towards 102.50 region is supporting the price at the moment. We have seen a bit of a technical bounce, but we do still see some vulnerabilities potentially here. Now, obviously you can see structurally we're to the downside as well, printing lower highs, lower lows, respecting that structure there that you can see on the daily. But everything is in the hands of key economic data. If we look at recent weeks, you'll see this slowdown that I'm talking about. Like last week, final ISM services PMI slowing down there. If you look here, obviously labor market data across the board were disappointed with the ADP employment change much lower. The unemployment claims ticking higher there, the highest reading that we've seen in around 11 months. The actual key non-farm payrolls numbers and average earnings, all of this was deflationary, okay? So really, markets have every right to ramp up their bets against the dollar and ramp up their bets for rate cuts from the FOMC. So if we fast forward to this week, we're going to be keeping an eye on PPIs and CPIs because obviously these are key inflation metrics. And when you look here, numbers are expected to tick slightly higher, slightly unchanged, generally speaking, if you look at the CPIs and PPIs there. But given the slowdown that we're seeing on some of the key economic data points, I would not be surprised if these come out lower, okay? And then, of course, we're going to keep an eye on retail sales because with retail sales, right, we've got this fear, one of the narratives that I'm talking about a potential US recession. If these numbers disappoint, which, as I say, given we've seen a number of key economic data points, a number of key economic metrics that are showing potential signs of slowdown in the US economy. For example, those key labor market figures that are slowing down, the amount of jobs being added to the economy, wages coming down, unemployment rate ticking higher. Are we really going to see a potential solid retail sales number? I think the risks are to the downside there. So with the dollar index, as I say, structurally here to the downside, lower highs, lower lows. Let's see, there's a key area of supply right now at this recent lower high, okay, which obviously if we fail to break this down, and obviously if the data here disappoints, lower PPIs, lower CPIs, lower retail sales, this is only a southbound potential trend, and we'll go and re-challenge these lows here of last week, and subject to a move in towards that 101 territory. So there are certainly some vulnerabilities there and key economic data points you must keep an eye on for the dollar this week. Plenty of volatility also expected around GBP, the pound, a massive talker point. We have some huge data points right now from the UK. If you look specifically at GU, obviously you can look at, as I always say, I'm just doing this as a base case, the pound versus the dollar. There's a number of obviously pound pairs that you can go and look at, but we're looking at GU right now. And obviously we have been trending to the downside. So there has been some weakness for GBP. Obviously, bear in mind, we're seeing weakness in the dollar as well, but there's been some weakness in pounds. So obviously GU heading to the downside for the last 1, 2, 3, 4 consecutive weeks. We had a rate cut, remember, from the Bank of England. They haven't quite left the door open to another rate cut unless inflation comes down. Now, on a talking point of inflation, this week, very, very important week because we have labor market data, right? And this labor market data is expected to worsen when we look at the average earnings. Remember, wages are important because if wages are coming down, that's disinflationary. If wages are coming down, that potentially means, as an economics 101 way of thinking, wages are coming down, potentially you've got less people out spending, stimulating prices of goods and services, then inflation should come down. And, Bank of England's fears or concerns rather around inflation should cool and obviously leave the door open to some more rate cuts. But we only get more rate cuts if inflation's coming down. So we'll keep an eye on that. Our unemployment rate expects to tick higher, which will be obviously GBP bearish, as you can see here. Inflation on a year-on-year expected to tick higher to 2.3%. Let's see, okay. And then GDP expected to worsen. So really, if you look at these expectations, these projections, we have room for potential GBP downside if they do disappoint, okay? We do have room for downside. And obviously here, it would make sense on a technical level as well. If you look on a daily, obviously we've caught a little bounce, some respite around this sort of 2680 area. You see where we bottomed out there, boom, over the course of Tuesday, Wednesday, Thursday, and obviously we bounced. Obviously, structurally, we're still to the downside. We're unable to sustain any upside pressure for GU specifically. You could just obviously, you can obviously just mark a trend line here and you can just sort of see where resistance is at, respecting that trend line to the south. It's not to say that we can break out of that. Obviously, to break out of that, this is where fundamentals, as I say, lead the way. Fundamentals first, technicals second. If these fundamentals do obviously surprise to the upside, i.e. we get better labor market data, inflation remains sticky, GDP surprises the upside, then obviously GU can break out to the upside from this, this descending trend line, which is keeping the price at bay right now. And as I say, we're respecting structure to the south. So do keep an eye on these key figures from the UK. Some more central bank action this week, this time from the RBNZ in New Zealand, where they're expected to keep rates unchanged at 5.5%. The key is their statement. Are they going to tee the market up for some rate cuts later on this year? There are certainly some growing cases for a rate cut. If you look at my screen here, I'm just going to show you New Zealand's CPI, for an example. You can see inflation starting to cool there, coming down to 0.4%. So remember, if inflation's coming down, it gets us closer towards rate cuts. Inflation's high, then we've got to keep rates high for longer to bring down inflation. Remember that. Remember Economics 101, guys. And then also as well, key is the labor market. If we take a look at NZD unemployment rate, the latest reading, and you can see here, unemployment rate last reading was slightly better, not as bad as expected, but still higher. Okay, and the previous was revised as well, worse, to 4.4% from 4.3%. So the actual number jumping up to 4.6%. So overall, it's not really good. Unemployment getting worse. We're seeing growth slowdowns in New Zealand. We're seeing inflation come down. We've got the secondary impact of the Chinese slowdown as well, the effect of Chinese slowdown. Remember, China is New Zealand's biggest two-way trading partner. So all of this potentially gears us up for a potential dovish, softening in tone from the RBNZ, and we could see some weakness in the New Zealand dollar. So if I just bring up the screen here, let me just clear some of this from last week. All right, if you look on a weekly here, obviously we staged a rebound. There's massive demand here for, obviously, I always say this is just as a base case. You can look at NZD versus other peers as well and form a, fundamental and then technical view. But massive demand here around just sub 59 towards sort of 58, 60, around 40 pip range there. So you can see we bounced there late April. And then again, sort of start of this month, okay, pushing to the upside, breaking above the demand area around this sort of, well, where we're at now, we're trying to challenge 60.00, big psychological figure. On the daily here, you can just sort of see that supply we run into there. But overall, if you look technically left here, okay, obviously, again, this comes down to the dollar performance. If the dollar fundamentals outweigh, i.e. they're very bearish, right? We saw with the lower PPIs, the lower CPIs, worsening in retail sales, NZD is going to still have an opportunity to push to the upside because of that will just be more dominating, right? Markets really have a thing for the dollar right now. So that would outweigh any potential weakness here of NZD. So we'll keep an eye anyway. There's decent demand, which we've now broken above, and we're going to go sort of form a supply, new demand here, which we could go and retest, and similar to here, get a bit of consolidation, potentially push to the upside into this mid-60 region. Obviously, depending on how the dollar performs, we could go on and challenge these highs. Oh, these are the highs of, no, not highs of 2024, but go and challenge this high area of June. Okay, so really potentially ramping up for a softening in stance from the RBNZ this week. Given, as I said, the fundamentals there, the worsening unemployment rate, the lowering in CPI, the back end exposure to Chinese slowdown, all of that. But as I say, depending on the dollar fundamentals, NZD could still have an opportunity versus the dollar to push to the upside, but there may be some near-term volatility to the downside, depending on how dovish the RBNZ are. Last week, there was a big recovery for the Aussie dollar. It has definitely staged a rebound after, surprisingly, we're still having a hawkish RBA. The Governor Bullock, she teed the markets up for the potential for another rate hike. given that inflation's still not come down to where they want it to. So that supported AUD to the upside. Now, this week, we're going to focus on wage prices. Remember, if wages are still high, that's inflationary, right? It only keeps inflation sticky. And then also we've got the labor market data, which is expected to remain solid. 20.4 thousand jobs added, but the unemployment rate expected to remain low at 4.1%, which is, again, it's inflationary. If we've got low unemployment, people still spending in the labor force, still out spending money. On a weekly, state of rebound there, reversal candlestick. Okay, you can see it really nice and clearly, this pin bar here that we formed on Monday, and then obviously validated by that closure above on Tuesday, pushing to the north now. And now we've got a bit of a retest of this mid-60 region. If that holds, by the way, guys, we can see moves to the upside, replicate this push to the north, go for a challenge of the 6620 area, see how we deal there, and maybe go in towards 6700, obviously, if that data supports it. So a lot of talking points this week, guys, across the board with GBP, dollar, Aussie dollar, NZD, plenty of volatility. Guys, have an amazing and blessed week, and I'll catch you on the next video.